What if I told you that the wealthiest people in the world often pay a lower effective tax rate than many ordinary workers? Not because they're criminals, not because the system is broken, but because they built the system, and they understand rules most people don't even know exist. Today, we are pulling back the curtain. We are going to walk, step by step, through exactly how the ultra-wealthy hide, protect, and multiply their money, legally, and why you have never noticed it until now. Before we get into the strategies, we need to fix a massive misconception that most people carry around every single day. Most people think that rich means earning a lot of money, a huge salary, a fat paycheck every 2 weeks. But here's the dirty little secret. Salary is actually one of the worst ways to be rich. And the truly wealthy, we are talking about billionaires and centimillionaires, they earn almost no salary at all. Here is the fundamental split that shapes everything we are about to discuss. Income is taxed aggressively. Wealth is taxed gently, or sometimes not at all. The wealthy do not earn money. They own things that produce money, and that distinction changes everything. Strategy number 1, and this one is the crown jewel. It's called buy, borrow, die. And once you understand it, you will never look at wealth the same way again. Here's how it works. A billionaire, let's call him Marcus, buys a massive block of stock in a company he founded. That stock is now worth $2 billion, but Marcus hasn't sold it, so he owes zero tax on it. Zero. Now Marcus needs $100 million to buy a private island. Does he sell his stock and pay capital gains tax? Absolutely not. He goes to a bank, a private wealth bank, and he pledges his stock as collateral. The bank gives him a $100 million loan at a 2 or 3% interest rate. This loan is not income, it is debt. In many tax systems, loan proceeds are not treated as taxable income, and debt is not taxed. Marcus now lives off cheap loans, his assets keep growing, he pays almost no tax. And when Marcus eventually passes away, his heirs inherit the stock at its current value, not the original purchase price, wiping out decades of untaxed gains completely. The loop resets. And we're only halfway through. The next strategy is the one real estate investors quietly use to wipe out huge tax bills. You are going to want to stick around for this one. Strategy number 2, the art of disappearing assets inside companies. Here is a question. If someone asked you, who owns the most expensive penthouse in New York City? You would expect to find a name, a person. But when investigators tried to trace some of the world's most expensive properties, they didn't find a person. They found an LLC, owned by another LLC, owned by a trust, registered in the Cayman Islands. This is called layering, and it serves multiple purposes at once. First, privacy. No one can easily discover who actually owns the asset. Second, liability protection. If someone sues the owner, they can't touch the asset because technically, a company owns it, not a person. Third, tax efficiency. Certain structures allow income generated inside these companies to be taxed at lower corporate rates or deferred indefinitely. Delaware alone has more corporate entities registered than it has people living in it. Over 2 million companies, many of them owning nothing but other companies. And it's not just the US. Similar entity structures exist in the UK, Europe, and offshore jurisdictions around the world. The wealthy don't hide money under a mattress. They hide it in plain sight, behind layers of legal entities that most accountants in the world don't even fully understand. Here is one that will genuinely make your jaw drop. Did you know that a billionaire can buy a private jet, use it for business purposes, and actually make money, on paper, just by owning it? Even as it climbs in value? It's called depreciation, and it is perhaps the greatest legal magic trick in the history of taxation. Here's the concept. The tax code assumes that physical assets, buildings, planes, machinery, equipment, lose value over time. So it allows business owners to deduct that assumed loss against their income every single year. Real estate investors can use depreciation rules, and in some countries, accelerated allowances to reduce taxable income on paper, even when the asset is performing well in real life. So they buy a $20 million building, earn rental income from it, and show a multi-million-dollar paper loss that cancels out income from other sources. Private jets, yachts used partially for business, vacation homes rented out part of the year, all eligible for depreciation strategies. The asset goes up in real value depending on market conditions. The tax bill goes down on paper. It is a feature of the code, not a flaw. Now we need to talk about one of the most misunderstood wealth strategies in the world, and one that gets the most positive PR: philanthropy. Look, many wealthy donors genuinely care about the causes they fund. That is real, and it is important to acknowledge. But there is a financial architecture to charitable giving at the ultra-high level that most people simply do not see. When a billionaire donates stock that has massively appreciated in value to their private foundation, something remarkable happens. They receive a charitable tax deduction for the full current value of the stock. They also never pay capital gains tax on the appreciation. The stock transfers tax-free. The foundation now controls that wealth, and it does not have to pay income tax either. But here is the part nobody talks about. The family often retains significant control over the foundation. Family members sit on the board, collect salaries, decide which causes receive grants, and travel to oversee programs, all funded by the foundation. The wealth hasn't left the family's orbit. It has moved into a tax-advantaged structure, generated massive goodwill and PR, and remains largely under family influence. The billionaire's name goes on a hospital wing. The tax burden can be significantly reduced. If shell companies are the walls around wealth, trusts are the moat. They are some of the oldest and most powerful legal structures ever created for wealth preservation, and the ultra-wealthy use them with surgical precision. High-net-worth families use trust structures to shift ownership, control, and taxation across generations. The names and rules change by country, but the goal is always the same: protect assets, reduce friction, and keep wealth compounding. In the US, one example is a structure called a GRAT, where assets are placed in trust, annuity payments return to the original owner, and any excess growth passes to heirs with minimal tax exposure. The generation skipping trust goes even further. It skips an entire generation, moving wealth directly to grandchildren and bypassing estate taxes at multiple levels. And an irrevocable life insurance trust? That allows a massive life insurance payout, potentially tens or hundreds of millions, to pass to heirs completely outside the taxable estate. Across jurisdictions, from the United States to the United Kingdom, from Switzerland to Singapore, wealthy families structure their estates in ways that can dramatically reduce the tax burden passed between generations. The specific vehicles differ. The outcome rarely does. So now the real question: why don't most people know about any of this? 3 reasons, and they reinforce each other perfectly. Reason 1. Complexity is a feature, not a bug. These strategies require armies of tax attorneys, estate planners, accountants, and financial advisors to implement. They are expensive, time-consuming, and deliberately opaque. The average person does not have access to these professionals, and even if they did, the strategies often require millions in assets to be worthwhile. Reason 2. The language is designed to confuse. Terms like tax basis resets, carried interest, capital allowances, and deferred gains. These phrases are not accidents. Complexity is camouflage. Reason 3. The conversation is misdirected. Most tax debates in public media focus on income tax rates, whether the top bracket should be 37% or 39%. But the truly wealthy have largely exited the income tax system entirely. Arguing about income tax rates when the rich live in a world of capital gains, loans, and trusts is like debating the best route to drive when the other person already has a helicopter. Now, what does this mean for you? First, none of this is taught in schools. Understanding how wealth actually works is one of the most powerful things you can learn. And the first step is knowing that the rules are different depending on where you sit financially. Second, some of these strategies scale down. Depreciation, legal entity structures, smart charitable giving. Versions of these tools exist for people with far less than $1 billion. Understanding the principles puts you years ahead. Third, this information is public. It is in court documents, tax filings, congressional testimony. The wealthy are not hiding their secrets from the government. They are hiding them from you, in plain sight. Inside complexity. The wealthy spend millions of dollars every year making sure the average person never understands any of this. And every single minute you spend learning how money actually works is a minute invested in yourself. If this video opened your eyes, if it changed even one assumption you had about how wealth works, then do me one favor right now. If this video taught you something you didn't know before, take 2 seconds and hit the like button. It takes literally 2 seconds and it tells the algorithm that this kind of honest, in-depth content matters. It helps us reach more people who deserve to know this information.